This is the Coins, Cashflow, and Conversations podcast. I am your host, Dakota Grady. Welcome to the podcast, y'all. And actually, I want to say welcome to this episode talking about investing, y'all. And actually, today, we had new numbers come out from the CPI, Consumer Price Index, about inflation. Why is it important when it comes to investing? Glad you asked. Well, this episode is sponsored by Upstate Eastern Central Solutions. If you need help with accounting taxes, contact me today at dakotagrady.com. And I got a resource for y'all on my website. Go to dakotagrady.com, click on the link that says accounting taxes and advisory. Go to the tax tab, and there's a resource for you about tax strategy to save you money in your business. dakotagrady.com is the website. Get that free resource today. All right, y'all. According to CNBC, talking about CPI investing, right? Stock market. We're going to talk about what investing is, what the stock market is, and based on these numbers from the CPI, about CPI, what should you be investing in? So, article from CNBC talking about headline, S&P 500 jumps 1% to post-record close any session above 5,300 for the first time. All right, so what does that mean? What is the CPI? Why is it important? So the U.S. Bureau of Labor and Statistics, they come out with what is called the Consumer Price Index. The CPI basically it's like an index talking about how prices have increased over time in a nutshell. So we have what's called a basket of goods. It may be food, energy, education, communication, services, goods and services in the US in urban areas. And it's tracking how those goods and services have increased over time. Well, the CPI for the month of April increased slightly by 0.3%, according to the report. Now, from last year, the CPI increased by 3.4%. That's what inflation is. Prices have gone up over time, which thereby reduces the purchasing power of money. That's simple. So, how does that affect the stock market? I'm glad you asked. When the CPI is low, i.e., when prices haven't increased significantly, what happens is that encourages the Fed, the Federal Reserve Bank, to not increase interest rates. When interest rates go up, it costs more money. It costs more to borrow money. When interest rates go down, it costs less to borrow money. All right. So if people are borrowing money at lower rates, that means there's investing money and they're borrowing, which thereby encourages growth in the economy. Where if you have too much growth, the Fed then increases the Fed rate, which then causes interest rates to go up, and people have to pay more for interest to borrow money, which thereby people borrow less money and they invest less. So the opposite what happened today. So again, the CPI said prices increased slightly by 0.3% and year over year by 3.4%. So in other words, prices have increased slightly from according to last month's numbers. So investing, again, the headline says that the S&P 500, which is basically the Standard & Poor's 500, which represents the stock market, it increased and had record valuation of 5,300, right? In other words. So what is the stock market? Stock market is like going to the store. So you go to Walmart, for example. You go buy goods and services too. Now you'll get some food from the grocery department and it goes to the bank to take out money. So you get goods and services from Walmart. All right. You have money to buy, give those things, right? You give them to the cashier, you take your groceries home. That's simple. Stock market is similar. What you can buy in the stock market is stocks, which is basically ownership in companies such as Walmart, Home Depot, companies that are on the stock exchange, which is basically where you go buy in those particular stocks or bonds. Bonds are basically loans that you give to a company so they can raise capital to fund their business. You can buy commodities. Commodities may be things that are, say, agricultural or raw materials. For example, gold, you may have crude oil, corn, coffee. Those things are commodities. So they're traded on an exchange, right? And then you have derivatives such as, again, a commodity. So it's derived from, well, it's actual saying that you can actually trade on exchange, right? You may have futures too, but basically you're saying, all right, you're gonna get particular, say some wheat, right, at a certain price in the future, at a, when that particular date arrives. So you buy those things on the stock market, those things that you can invest in, right? You can also invest in real estate. I think it's called real estate investment trust or REIT. So those things you can buy. You buy assets on the exchange. It's basically like a store. You buy and sell assets in the stock market. That's simple. So the news came out from the Labor Statistics Board, right? Or US Labor Statistics, or the CPI increased slightly and encouraged people to go invest, and the stock market just blew up, right? So people go buy and sell those assets on the stock market, and people grow. They make money or lose money. It depends on what you're investing in. So now that we have that understanding about the stock market, why should you invest in the stock market? Great question. You guys should ask that too. Well, the stock market is one way I believe people can grow wealth. If you have a company, say Home Depot, using them as an example. I'm not getting paid for that, but Home Depot. That company has, I'm sure the valuation of that company has billions of dollars in assets. It's worth that much. It's grown to a stable company in the US, right? I'm sure it's a fair summary, right? Well, if you go invest in that company, they go buy shares of stock in Home Depot. They're saying, I want to invest my money to grow, right? I want to invest my money in this company because it's growing. It has stability, a track record of winning, and maybe even do a dividend, which is basically when the company is earning money and they want to reward their investors, they give a dividend, which is earnings for the company, right? They give dividend to the investors. When you invest in the company, they use that money to fund their operations. And then you get a return on investment by either the stock increasing in value, growing, or you get income through a dividend. Or if you do a bond is basically you loan money to a company, they give you a maturity date, say a 5-year maturity date, you're going to get, during that time of you investing your money into that particular business, they're going to pay you interest rates or interest income. And then at the end of the 5-year period, when it matures, the bond expires, they'll give you the principal amount that you invest in the company. That's simple. But that's what happens when you invest. You invest in things that are going up in value so that you can get a return on your money. Same thing with banks. Banks loan money and they charge you interest. The interest is the cost of borrowing money. When you invest in a company, again, they're giving you a return on your investment, something that's going to go up in value, hopefully, for you investing or putting your money in something that's going to grow and have a benefit for you and the company. Both people win. There's no losing. It could be a loss, but you can lose money and they get too. So there is risk in investing in the stock market. But according to investopedia.com, the stock market has gone up over time at an average of 10%, right? You can get, that's pretty good. If you go invest in a bank, not invest, but put your money into a bank, say, even the high yield savings account, maybe 4.5%, or you may get something lower at a savings, like a savings account, just a regular savings account, you may get 0.1%. Small amount, right? That doesn't compare to what you get from investing in the stock market. Now, again, there are risks. You can lose your entire investment by investing in the stock market, but the more risk you accept or take, the more reward you get. The less risk you take, the less reward you get. Again, if you go and put your money into a high yield account, you might get 4.6% roughly. That's not really a lot, but if you put your money into the stock market, you can get up to 10%, even more, depending on the investment and depending on how much you invested, and then also the time you have invested into that particular asset. But again, it's all about risk and reward. How much you're willing to accept in terms of losing if you put your money into this asset. But the reward is, if you don't lose, you have the opportunity to gain from investing. So you know what the stock market is, why you should invest in it, because you want to help you to grow your wealth. When you invest in the stock market, hopefully it goes up over time. Again, since its inception, it has gone up on average 10%, which is a pretty good investment, return on investment. And what should you invest in? Great question. Again, I mentioned stocks, bonds, commodities, futures. I didn't mention options. Options are derivative, meaning they derive the value from a stock, right? So an option could be, all right, I'm going to say an option is kind of like a reverse of a stock. A stock goes up in value. You look into, say you buy a stock at $10. You want to sell it at $20 because you're going to get a 10%, or you're going to get $10 extra than that actually was worth. You put $10 in, you got $20 back, you got $10 extra than what you actually invested, right? Well, what an option could be is you say, all right, I'm thinking that this price of a stock is going to go down. It's $10 now, but I'm thinking it's going to go down to $5. And you could win money or get money by betting that the stock price is going to go down to 5, opposed to going down to 8. And once you reach 5, you cash out, boom, and you have made money. Or if you didn't have a stop loss, you could lose money. So options are tricky and riskier, even riskier than actual stocks, because of it's not the unknown. Stocks, you know that they can go up and down, of course, and options can go up and down too, but it's more of, I guess, more of a science. With stocks, you just put your money and let it go or lose, up and down. Option, you gotta really study the game, understand, and I guess almost like you're betting against something negative happening, possibly. But I recommend investing in what are called mutual funds. What is a mutual fund? A mutual fund is basically as a basket of companies, right? Again, you got Home Depot, Walmart, Lowe's. You have maybe a company such as, I don't know if they're a publicly traded company, but say a Slim Husky, for example. I don't know, but just use an example. You put all these stocks in there, over 100 stocks, for example, in one basket. And if one sector goes up, say you're in the tech industry, right? And then you have a bad industry, say you may do consumer goods. Well, if tech is doing well and consumer goods aren't doing well, it'll kind of like balance it out. But if you put all your money into, say, you get your own portfolio of stocks, so you get 10 stocks, right? You're going to pick your own stocks, right? You put all your stock investments into tech companies, right? No, you don't diversify, which is basically saying you're going to spread your assets out, your money out across a variety of investments. So that's what a mutual fund is. You're putting your money into, say, 100 or more stocks, right? You're not putting all of it into one basket, all tech, all medical, all healthcare, all consumer goods. You're putting it in different ones. Say you may have some tech, medical, you may have consumer goods, you may have real estate. You have all those, a mixture, diversified. You're spreading your money across different things, opposed to putting all of it, investments, in one basket. All right. So you have less risk of losing your money in a mutual fund because you have more companies in different sectors, in different industries. If one goes up, one may be down, it kind of balances each other out, opposed to if all your money is in one basket and the whole thing goes down, you out of luck. You're gonna probably lose your shirt. But you want to diversify your portfolio, and I believe you get diversification with a mutual fund, and specifically growth stock mutual fund. You get growth, which is basically a company that's growing, such as a Home Depot, a Walmart. They're stable companies that have a proven track record of basically producing goods and services that people want and need, and they're growing, right? So growth. The value, you started at $10, and in 5 years it goes to $35, for example. So the value of that stock price has increased. Then you have a growth and income, which means you're getting growth of the company's value, right? And you're getting income, which I mentioned earlier, which is a dividend. You go investing in stock mutual funds, you're going to get a dividend from a growth stock mutual fund. On growth and income mutual fund, you're going to get growth, value increasing, and income, meaning a dividend payment to you for you investing your money into the business, right? So you get growth, that's one. You get growth and income. You get aggressive growth, which means you're going to get companies that are growing really, really fast. Say a new tech company, startup is growing, expanding really, really fast, and they're giving, say they want people to invest in them. They want to do an initial public offering, IPO, and they're offering people to invest in the company and get dividends in the future, not now, but in the future. And growing rapidly. That's what would be a company that would be an aggressive growth company. And again, offering shares will stop people to invest in the company and become owners. Then you have world companies or international growth stock mutual funds. So basically, you have companies outside of the US that are growing growth stock mutual funds, aggressive growth, and then international stocks. So they're growing and maybe stable, but they're not in the US. So those are the type of funds I recommend getting. So again, you're gonna get a growth stock mutual fund, a growth and income mutual fund. You're gonna get aggressive growth stock mutual fund, and you're gonna get an international or world stock mutual fund. That's simple, y'all. And I'll do 25% per fund and keep investing in and investing in and investing in. And hopefully your fund will reward you by you staying into the stock market, you staying invested into the stock market. Don't pull out when they get difficult. Stay in the game. Don't let your emotions dictate you investing in your future. Because one way to build wealth is by investing. And if you aren't interested in investing in the stock market, that's fine. I recommend also investing in one, yourself, growing, getting knowledge, continue to improve yourself, your skills, your abilities to increase your income through a job or business. And the second way is through a business. Create a business, create goods and services that people want and need, and grow wealth. And the third way I recommend investing is in real estate. If you can afford real estate, get you a piece of property, get you a house, condo, duplex, triplex, whatever you want to get, rent it out, or maybe even commercial, rent it out for rental income. Also get depreciation expense, which reduces your taxable income. So those are ways I recommend investing. Invest in the stock market. If you can, if you're afraid, do it anyway. Do your homework, make sure you understand what you're investing in, why should you invest, and how to invest. Never invest in anything or buy anything that you don't understand. If you can't explain it to a 5-year-old, you aren't ready to invest. And invest in the business and invest in real estate. Before you do any investment, though, I recommend first doing a money plan or budget, all right, every single month. Secondly, get caught up with your bills. If you're behind, get on a money plan, get caught up with your bills. Once you're caught up with your bills, secondly, get a rainy day fund of $500 to $1,500 in the savings account. You can do a high yield account too if you want to, a money market account or savings account. It's meant for you to have savings for rainy days. That's simple. It's not a vacation fund or a retirement fund. It's for saving for occasions for you in life. Then once you are out of debt, pay off your debt, all your debt, sell your house. If you got a house, keep your house, and then start investing. And then once you are investing, crush that debt, pay off the house. That way you can ramp up on your investing in your retirement funds, 401k, IRA, Roth, or traditional, and then start investing in the business and then investing in yourself, stock market, and also invest in real estate if you can. So I hope you like this episode of the Coins, Cashflow, and Conversations. I want to bring some content to y'all which was fresh, new, relevant for today. And I hope you can use it and add value to your life. Don't forget to click the subscribe button below and tell your friends, family about it. Share the podcast. And lastly, this is the Coins, Cashflow, and Conversations podcast, sponsored by Upstate Essential Solutions. Contact me today, Dakota Grady at dakotagrady.com. Get the free resource, y'all, on the accounting, tax, and advisory page. The drop down by tax solutions. Get your strategies on how to save money in your business. This is the Coins, Cashflow, and Conversations podcast, y'all. Thanks for joining us.